Hi, welcome to Bond Bytes, a daily bond market highlights from INR bonds. I'm Arjun Patsati. And in today's Bond Bytes, it's a special edition where we are going to talk about the implications of the new tax laws changes on debt mutual funds, MLDs, and also on FPIs on the fact that withholding tax has been increased. And I'm very, very honored actually to have Mr. Ranganathan with us. Mr. Ranganathan is a tax expert and in the hallowed circles of consultancy and corporate boards. Mr. Ranganathan's views are like almost sacrosanct. And hence, and Mr. Ranganathan is a regular blogger, and you can all on various matters of capital markets and tax and many other issues, and which is very, very informative. At least for me, I have been learning a lot from the time I started to follow Mr. Ranganathan's blogs. And we are very welcome, Mr. Ranganathan.
Thank you, Arjun. It's a pleasure to be part of this discussion, and I feel quite privileged to have been invited to this forum. And I have been quite regularly listening to your podcast on the debt side of investments, and I've seen it to be very educative. So thanks once again for inviting me, and let me leave the floor to you to raise the issues that you want to discuss today.
Sure, sir. Thank you, sir. Just before we start, Mr. Ranganathan's blog can be accessed in the description below. Please do follow his blog as it is most informative and absolutely for capital market professionals and even for investors, regular and non-regular investors. It's very educative and informative. Yeah, so let's get on with the new tax law changes. Mr. Ranganathan, in the finance bill that was passed last week, now, there's been specifically in the budget in February, they had actually mentioned about MLDs, and they clarified a bit in the finance bill. But even more important, is a couple of changes that have come through is that on the debt mutual funds and on the withholding tax for FPIs. So we would like you to have your elaboration on these on these tax law changes in the finance bill.
Sure, Arjun. I think the budget and the finance bill, which has now subsequently been passed, which will very soon get approved, assented by the President and will become the Finance Act 2023, has come in as a rude shock for investors in the debt space. Because it has made very drastic changes with regard to how the taxation law was being applied to some of the debt products. And I'm sure many of the people who are invested in mutual funds and who are looking at debt as a very important segment of investment would have to make fresh decisions with regard to how they invest. And whether some last-minute changes would be necessary to protect their tax position with regard to their past investments. So many things would be haunting the minds of people who are invested in the debt space. And it's very opportune that you have brought about this discussion. The very unfortunate thing has been a very major change in the system of taxation with regard to debt mutual funds, which has been introduced as part of the final changes to the finance bill, which unfortunately was not even discussed in the parliament, as the parliament has not been functioning for the last many days. It is not entirely the fault of the government, but it's the political process that has completely let down the citizens of this country, whose only avenue is a reasonable amount of discussion in Parliament before any law is brought into force. And unfortunately, even that opportunity was missed with regard to this year's finance bill, because after the budget, the Parliament, when it convened, I think from the early part of March, has hardly been functional. So there has been absolutely no opportunity for any debate with regard to this particular change, whereby the historical position that mutual fund investments, whether in the debt space, would qualify as a long-term capital asset if it was held for more than 3 years. That has now been upset by the change brought about by the finance bill, which will become Finance Act.
Sir, why do you think this law has come about? Is it to normalize the whole tax incidence on investors, especially the fact that it's been used or misused by the industry and as an arbitrage product, and most of the investments have been on through large treasuries and high net worth and ultra high net worth individuals? Or is it something that the government is keen on rationalizing the whole tax process?
That's a very good question, Arjun. I think it's very important to give a holistic perspective and not take a very narrow and a very partial view on these matters. While I did say that the change upsets the position with regard to investors who have been looking to this product for a tax optimization, I would, at the same token, have to recognize the fact that arbitrages in the tax law is one form of inefficiency in the system. So wherever arbitrage opportunity exists in the tax law, they have to be smothered. And one such aspect has been the benefit which the mutual fund debt schemes were enjoying, essentially, let's say the growth schemes, over comparative products like a corporate or a bank fixed deposit or a direct investment in bond, creating an arbitrage and an advantage to funnel investments through a mutual fund route. So your question is absolutely right. There is definitely valid basis from a philosophical principle angle for improving the efficiency of the tax law. See, the tax law is efficient when it makes no distinction between different forms of income, when it makes no distinction between similar type of income earned in different ways. It is important that the tax law recognize only one fact, that people who earn more should pay more tax, people who earn less should pay lower tax. Beyond this differentiation, there should be no other arbitrary or artificial differences in the tax law by which some type of income enjoys certain exemption and other type of income do not enjoy. Because every form of income is in some sense finally dependent on the kind of risk, the tenure, and the various factors which are economic factors that determine the nature of the income. And the tax law should not make any such distinction. So to that extent, I feel that this was long overdue to rationalize the way of taxation of a similar income, which one earns either through mutual fund investment or through a corporate debt or a corporate FD or a bank FD. So I see this as something which was long required. So to that extent, it is fine. Though the manner in which suddenly it has been brought about, I think it deserves some more time frame for people to rearrange and rework their investment pattern. So that would be one very important aspect to be taken note of while appreciating this change. And we should not be only guided by the fact that there has been some detriment caused to the investors. The other point that you mentioned, very valid, is that maybe these debt schemes were being significantly accessed by large corporate treasuries who could clearly see an opportunity to get the benefit of long-term taxation, which is both the lower rate of tax as well as the indexation benefit, which is not available if you make direct investments into debt products. So by and large, I think the opportunity which the corporates were, to some extent, I will not call it an abuse or a misuse, but they were taking an undue advantage of this system. And that might get now sorted out by virtue of these changes. So I limit
Yes,
my
sir.
answer to this at this point in time. If you have any further questions to trigger on this, no, please go ahead.
Sure, sir. Actually, my own reading also is that it increases market efficiency, because we have seen that when there is tax arbitrage available, there tends to be excesses. Now, we'll just name two tax arbitrage products. There were these corporate credit funds, which after the collapse of ILFS and DHFL, they spectacularly failed. In fact, there was a fund called BOI AXA, which was a credit fund. It lost about 60%. And then everybody knows about Franklin Templeton. And all these were positioned as 3-year plus products in lieu of fixed deposits, largely with the capital gains tax benefits and higher returns over the fixed deposit. And so such kind of implications then also lends to market efficiencies, where there is flows that is leading to less pricing inefficiency, and also credit risk is disseminated properly in the market. One more, I mean, just coming back to MLDs again, sir. MLDs was a very strong product for high net worth individuals, and gained a lot of traction over the last couple of years. Now, from suddenly, it's shot up to well over 50,000 crores of MLDs issued in bonds outstanding. And again, here credit risk was being misused. So clearly, market efficiencies improve, and more people will look at bonds holistically, look at the credit risk. What is that in terms of the returns they get in return to the risk they take on the bonds, and and any other product as well. Sir, in your opinion, now couple of things on the MLD tax law, which there was a slight clarification in the finance bill in that it applies only from April 1st. And the second is that in that mutual funds now, debt mutual funds are now are being classified as short-term capital gains returns. But would say, for example, investing in a listed bond for a 3-year plus period, would that, supposing you're investing in a 10-year government bond and the price goes up, would investors be eligible for long-term capital gains tax benefit on that?
The changes currently affected do not change the position with regard to how the gains on direct investment in bonds is actually taxed. There is no change in that. So if somebody had invested in a government security or in a bond issued by a company or a PSU, and it is held for more than 3 years, and there is an increase in the value at the time of redemption or on a sale, this would be treated as a long-term asset, and I have not noticed any change with regard to that. The only thing that I have noticed, and if I have missed something, you can feel free to correct me. Only these two products, that is the mutual funds which invest less than 35% in a scheme in equity. If it invests more than 35%, then there is a different classification for that. But as long as it invests less than 35% of its average investable money in equity, and with regard to MLD, post 1st of April, any gain arising with regard to these two products will be treated only as a short-term capital gain, and it will not be entitled to the benefit of long-term capital gain. This is the only change that I have noticed. But in case I have missed out something, you can bring in that angle as well.
Yes, sir. Just a couple of questions here. One is, if investors are holding MLDs and they are maturing next year, they had bought these MLDs prior to the budget, which is in February 23, and have invested and are holding the MLDs, would they still be eligible for long-term capital gains tax if they hold it over a year plus and sell it before redemption? That is one. The second is that on the mutual funds itself, now investors have the benefit of what is called grandfathering. So would that mean that investors who have invested in debt mutual funds for a period of 3 years, I mean, just invested recently, would they be eligible for the long-term capital gains tax? This is just to clarify so that investors can take their decisions accordingly.
This is a very important question you have raised. And I think the government should be appreciated and thanked for having clarified this position, one with regard to the MLDs, which was initially introduced in the budget without sufficient clarity as to what would happen to MLDs, which were already issued and invested by investors before the introduction of the budget on 1st of February. In fact, I also remember, this question was raised in the media, and you had also brought up in your podcast with regard to the status of taxation of the existing investments. The government has now clarified that the treatment with regard to the changed position in tax, whereby it is taxed as a short-term capital gain, would arise only in respect of investments made after 1st of April 2023. Or maybe after 31st of March 2023. That means anything from 1st of April would be subject to the new law. So all investments already made, even if they get redeemed 2 years, 3 years down the road, the old law will apply. So this position has been brought about to not unfavorably disturb past decisions taken, which cannot be reversed by virtue of the proposed change in law. So the government has understood this implication for investors, and they have been quite gracious about making sure that the old investments do not suffer by virtue of the change in law. The same position applies with regard to the debt mutual funds, where the investment in equity is less than 35%, whereby if somebody has made the investment, and in a way I should make the point that investors have still left with, I think, 3 working days or so before they can make further investments into these schemes, which would be entitled to the benefit of long-term capital gains taxation if they hold it for a period of 3 years. So to that extent, again, the people have not been, while they have been taken by surprise by the change, but I think they've been given enough time to plan and change their portfolio if required in the 3-4 days intervening between the change announced and the 31st of March. So in both these regards, there is no disturbance to the past investments, and the change applies only for fresh investments made after 1st of April 2023.
Yes, sir. And also, we had a discussion on expense ratios, and you felt strongly about it. I think you have to put it out, sir.
Yeah. See, the subject is a little complicated, and it's very difficult to explain it very briefly. So I may need to take a couple of minutes to get into this point. See, one of the inefficiencies noticeable with regard to making investments in the debt category of mutual funds is the level of expenses charged in these schemes. Clearly, the investors lose value by virtue of the expenses charged, which again is much higher if it is investment in the non-direct category, which is, I think, called the regular category, and in the direct category, it is on a slightly lower side. But nevertheless, when one goes through the various debt fund schemes of the different fund houses, there is a huge discrepancy and differences across the fund houses with regard to charge of expenses. While I do recognize and notice that funds which require investments into corporate bonds of a longer duration, etc., would take more effort on the part of the mutual fund team to make enough analysis of the credit risk, etc., compared to investment in easier options like treasury bills and all that, which doesn't really require a great deal of study and evaluation. The funds do make a difference in terms of the level of expenses, But I would tend to think that even on in cases where whether it is a credit risk fund or corporate bond fund or funds of a longer duration like dynamic bond fund, the level of expenses charged over years should ideally be coming down, because the mutual funds have picked up more ability to manage this, and now artificial intelligence is available, which minimizes the level of human efforts. But one doesn't really see whether this is got translated into benefit to the investors. So one of the critical aspects to look at any point in time investing through mutual fund is the amount of expenses charged. And there is no permanency to the amount of expenses, because when I invest, I may notice it to be low, but 6 months down the road, they can increase the amount, within the permissible limit allowed under the SEBI rules. So this is a very vexed issue, and it really requires a lot of effort on the part of investors to constantly monitor. And if they really notice the sharp increase in expenses, and if they exit the scheme, then they will end up paying tax. So to some extent, the investors are locked in into a particular scheme, given that entry and exit on a random basis is not very tax efficient. So there are various aspects at play, and my fear is that the change in law, which might logically compel existing investors to be locked into these existing investments, at least for a period of 3 years, to get the benefit of long-term capital gains. And even if they continue beyond 3 years, they will be entitled to the benefit even for eternity. Somebody holds it for next 50 years, technically they're entitled to the present position in law,
Yes,
unless
sir.
the law itself is changed subsequently. So given all these factors, I think there has to be sufficient vigilance to ensure that the mutual funds do not abuse the position and increase the expense rates to these existing schemes. One of the fear that I have is fresh flow into these schemes will now stop. I doubt whether people will invest in large quantum into the existing schemes after 1st April. So there will be stagnation in AUM, and the AUM only start coming down as people redeem whenever they need money. So there will be a temptation for the mutual funds to continue to maintain the old level of expenditure, which as a percentage of the AUM will start going up. So the people who are continuing to remain in these funds may suffer a lot more in the longer run as they hold the investments over a longer duration. So I see many variables, many potential issues. So I think it is important for various agencies, including the regulator, to really look at this very closely and make sure that the investors don't lose in the process. I've taken a longer time to explain this. I hope I have come across clearly about
Absolutely, sir. In fact, registered investment advisors, RIAs, who are fee-based, they should actively monitor and then highlight it. And if need be, go with their forum, ARIA, and others too. The regulator, if expense ratios are being misused. So coming down to the last point on the withholding tax for FPIs, especially this is because a lot of AIFs and others have been now opened in GIFT City, and now what is the, and foreign investors may see that there's too many kind of changes. So what's your opinion on this, sir?
So this is again a very pertinent question, and I would slightly expand the scope of my answer to not just the FPI part, but even the existing position with regard to the withholding tax exemption, which was available for debt securities which are listed in the market, has been changed in the budget. So historically, interest on listed bonds were not subject to withholding tax or TDS because of the fact that the bonds can change hands, and it is difficult to trace it to the income exactly to the person who has earned it, whereas the tax deduction will be suffered by the person who actually receives the interest directly from the company. So there is bound to be a mismatch between the amount of income received and the tax which is deducted. So to a large extent, I think this will be a disincentive for active bond trading in terms of the change that has been introduced. So the other aspect which you brought about, which you raised as a question, is with regard to the withholding tax on the bonds which are invested through the markets which are operating in GIFT City. I think the rate has been increased from 4 to 9%. Again, I see this as a major disincentive. The basic issue is TDS is being seen as basis of increasing tax revenue. I think this is a very mistaken belief. TDS is just a form of collecting the tax. It doesn't by itself generate tax. And the current level of technology, transparency, and the electronic mode of operations doesn't permit any kind of tax evasion on these products. See, TDS is normally to be pursued as a way of collecting tax only when there is fear that the person earning income may not disclose it and may hide from the clutches of the law. That perhaps was true 20, 30 years back when systems were very inefficient and the government machinery also lacked the ability to trace the taxpayers. But today it is a very changed situation. In fact, the government gets these information far earlier than any other agency, including the person who is receiving the income. So the approach of expanding the footprint of TDS, I would see it to be very negative, and it is really going to affect the efficiency of the markets. So whether it is FPIs or even the local bonds, I think the government should be persuaded to revisit this change because this is definitely a dampener as I see it.
Yes, sir. So just one last question. Coming back to bonds, now government GSECs do not have TDS. Since they are listed bonds, now would they also be subject to TDS now? The government will have to, deduct TDS for interest for holders of GSECs?
I have not specifically checked this. I just assume that the TDS will not apply on GSECs, but I think this needs to be checked to see if this is the case. To a large extent, I think GSECs are not still being invested in by the retail investors, though the facility is available for retail investments. I don't think people are really enthused to invest in GSEC through the retail mode. So to some extent, it may not have any implication for the retail investors, and the corporate and the banks, they will manage it because they have the systems to deal with it. But yes, with regard to corporate bonds, since the avowed objective is to expand the footprint of corporate bonds and then create a very robust retail trading platform for it, I think this TDS is ill thought out. And I think the government should be made to realize that this is a very backward step, and they should revert to the
Yes,
old position.
The market regulator should take it up with the government, actually. Even for GSECs, retail GSECs now, platforms can actually, if RBI permits APIs and others, can enable more retail participation in government bonds because they offer they offer a very nice, good product, risk-free, and a very good alternative to FDs as well. So with this, I think, thank you for the time, sir. I think we've taken a lot of time, and I'm sure all our listeners will definitely will have much better in the sense of what the whole taxation law is and takes investment decisions accordingly. Thank you very, very much. And if you're a financial advisor, obviously the best place for you is in our bonds partner portal. You come into become a partner now, log into INR Bonds, become a partner, get the best bonds available, most information, absolute price discovery, and the easiest of investment processes. And for a curated list of bonds, download our app, Quick Invest by INR Bonds, for the best list of curated bonds on offer, again with our own proprietary score and easiest of in-app investment processes. Thank you very much.
Thank you.
As a financial advisor, my biggest responsibility is to help my clients make the right investment choices. Now, with INR Bonds, buying and investing in bonds for my clients is quick and easy. With my guidance on bonds, my clients are happy and I'm getting new business every day. Register as a financial advisor on inrbonds.com to help your clients invest and save better through bonds.